Hello again and welcome to our Hightower Signature Wealth monthly fireside chat. Our goal, as in every other month, is very simple. We want to step back from the daily headlines, the noise, and provide perspective on what truly matters for long-term investors. I'm Matthias Kuhlmeidt, Chief Development Officer of Hightower. And as before, and always, I'm joined by Stephanie Link, Hightower's Chief Investment Strategist and Head of our Investment Solutions team. Stephanie brings decades of institutional experience and a very disciplined approach to navigating complex markets, which we're in, no doubt. Last time, we focused on the continued resilience of the US economy, the evolution of AI, and the broadening of market leadership. And today we thought we'd like to build on our past discussion and focus on what is moving the world these days. And to many, we must note it has been a total surprise that markets continue to grind higher against a persistent backdrop of uncertainty. And Stephanie, I thought, why don't we just start there?
Yeah.
There is no shortage of concerns right now. Geopolitics, inflation, Fed policy, and even the questions around the sustainability of the AI trade. And yet, as I said, markets continue to grind higher. Stephanie, how should investors make sense out of a market that continues to advance in the face of so much uncertainty?
Well, thank you, Matthias, and it's great to see you again.
Yeah.
I am going to sound like a broken record, I think, but as you know, the simple answer is stocks follow profits on the way up and on the way down. And what we have been seeing over the last couple of weeks, months, is that earnings are actually moving higher. In fact, about 90% of companies have reported the first quarter earnings, and the numbers were up 25%. I mean, I have never in my lifetime seen 25% earnings growth, maybe out of COVID coming off of the deep, decline, but not only is it earnings, it is also revenues are growing up 11% and margins have expanded anywhere from 50 to 70 basis points in the face of all of this inflation and a lot of the uncertainty. So why are earnings going higher? And interestingly enough, Matthias, multiples have actually come down. So earnings are going higher. Multiples have gone from 23 times forward estimates to 19. And why? But why is the market going higher? And the market is going higher because the economy continues to chug along. And the Atlanta Fed tracker right now is at 3.7% for the current quarter. That's remarkable in the face of all of these unknowns that we've talked about in the past. We had Venezuela. We had SCOTUS overturning tariffs. We have AI and AI taking over the world, and especially on the software side. We had private credit. Now we have a war. The point being is the economy is so resilient because two things. The consumer continues to consume for now, and they're consuming because they have jobs. All of the data last week supported that, whether it was non-farm payrolls, weekly jobless claims, ADP, Challenger Gray, all came in better than expected on the labor side of things. And so the consumer is actually spending, because that usually happens. If you have a job, they spend. Wages are running 4%. And then the bigger piece is AI is driving the economy as well, probably 70% of the economy at this moment in time. And AI and the whole, what I call the food chain, meaning data centers, grid, and power, all of those industries are absolutely crushing it. And they are driving the higher earnings. And I don't think a war is going to actually deter this theme, given that it is really a revolution. And maybe some of the stocks are expensive. I'll definitely give you that. But I do think that this is a theme that is going to be around for a long, long time.
Stephanie, thank you. And when we prepared for this segment, we shortly labeled it the wall of worry, the old traditional Wall Street concept. But playing back what you just shared with us, the fundamentals, the underlyings are really, really strong. It's not even the wall of worry. I want to come back one more time. Sitting here among our advisors today, there is still that peaking interest on the war. But what if it takes much longer? How long will it last? Could this really derail then this solid foundational drive to the markets?
Yeah, I mean, it's a very good question, Matthias. I think if it goes for years versus months, we're in trouble because you can't have $100 plus oil. And it's not just oil because it's feeding into so many other parts of the commodity world. And so there is real inflation. And we did not get a good report today from the PPI or even yesterday for the CPI. Inflation is definitely elevated. We know that. We don't have to get a report to tell us that. So if this war goes on for, say, 6 to 8 months, um, that's going to start to eat into, I think, the consumer. And that's 70% of our economy. We can't afford to have the consumer roll over. We could afford to have the consumer slow down, but we can't have them collapse. And so that's the thing that I pay very close attention to. But I do come back to, I don't think the war will impact the AI theme. And that is the momentum for now that is really driving the economy. And I would say also a little bit, at least for the consumer, maybe they're getting helped in the near term from the one big beautiful bill. I mean, whether you think it's beautiful or not, it's not the point. There's a lot of fiscal policies being put in place to help the consumer. And so maybe for now they're able to hang in there, but given that we have all these inflationary pressures, but then I come back to it's also K-shaped. And the wealthier individuals, they're able to handle a little bit higher inflation because of the wealth effect. They own stocks, they own a house. That's not to be the case where the middle class or the lower class.
Yeah, Stephanie, it's really, really interesting. So it is really less about the headlines. It is more about the underlying fundamentals. You state the earnings and the consumer, which accounts for significant activity in our economy, is strong. Let's stay with the consumer for a little bit, because you said we didn't get a good inflation reading or report. What could possibly go wrong? Consensus has been consistently been too negative on the consumer. Where do you see other drivers? What are we still underestimating?
Well, I mean, I think that for the consumer, first and foremost, we're a nation of spenders. We just are, whether we have the
Yeah.
money or not, right? And again, I I think that the upper end of the consumer is doing quite well. I wish that to be the case for the middle end and the low end, but that's not the case. But it usually is the 80-20 rule, as you know, that the top earners will account for 80% of the spend. So I think if oil were to spike much higher and it goes up very quickly, like I'm talking $140 a barrel, that would be problematic even for the high end. I think you would see demand destruction. And so we do have to keep an eye on the inflation side. That's out of our control. We have no way of forecasting how long the war is going to be. What is in our control is really on the fundamental side, on the labor market, and that's why I pay so much attention to the numbers that are coming out on the labor front. Like the weekly jobless claims, Matthias, last week came in at the lowest level since 1969. That was the year I was born. So we're at levels I've never seen. But non-farm payrolls also came in much better than expected, and average hourly earnings were still very solid. So keep an eye on the labor front, and then keep an eye on how long does this war actually last, and we'll have to keep an eye on what the consumer does.
Very good point. And Stephanie, I read one of your recent reports, and I was actually surprised. I had not done this work before. Gasoline is only 3% of spending,
Yeah.
meaning you said energy shocks are really less impactful. The consumer stays strong unless the war, as we heard from you, will take longer. Stephanie, let's talk about the Fed. Another very hot debated topic, and expectations seem to have shifted quite a bit. Is the bigger risk today from what the Fed does or how it communicates what it is doing?
Yeah, it's a very good question too, because I really hope, and now I don't know this to be the case, I really hope we don't have these daily battles between Trump and the Fed chair like we just did under Powell. I know that Trump wants lower rates, but there is no way with inflation where it is today that Kevin Warsh, who's the incoming Fed chair, that he will be able to cut rates. I know there are a lot of people talking about they eventually might have to raise rates. I don't think that's the case just yet. I think that's way too premature. But they're not going to cut, not in this environment. What I would say is I do hope that Warsh is going to be able to kind of corral the vote, all of the members, but especially the voting members, and to get them all on the same page. We've had a number of dissenters over the last couple of meetings, and that's troublesome in terms of getting any kind of policy done. But that's a big one. And then I really do also hope that he actually tells the other members of the Fed not to go and speak in public so often. I think that's one of the things that's very confusing for people, even people like you and I who are in the business. You have one Fed governor saying one thing and another Fed governor saying another thing, and it's very often it contradicts from both sides. And so, to me, I kind of hope the communication just dies down a little bit. And that he can get all of the members on the same page. But there's a lot of work ahead for our new Fed chair for sure.
Absolutely agreed, Stephanie. You gave me a good in. We haven't talked about it before. President Trump has traveled to China. What do you make out of that current development? There has been a lot of, let me say, noise in the background with potential economic impact. What are your thoughts on these developments?
I mean, I have a hard time believing we're going to see massive change. I do think it is very interesting, all of the CEOs that are joining him at this meeting. We have a number of companies of CEOs that joined President Trump, and I think there's a lot to ask for. I don't know if we're going to get it, but the Trump administration is certainly making a point to make a compelling case by bringing the CEOs to directly ask for improved relations with China. Whether it happens or not, I don't know. But it's certainly going to be fun to watch over the next couple of days.
Absolutely agreed. Stephanie, we need to return because of increased interest among our clients and friends to the AI topic. We have discussed it almost every month.
I know.
It continues to dominate the investment landscape, not always in a good way. Stephanie, where do you think investors are still misunderstanding the AI story?
I think they're misunderstanding some of the sectors that are benefiting so substantially. And as I mentioned, we all know about AI. You need data centers, you need an upgraded grid, and you don't have enough power, and you need power. That's all good. But I think it's really the industrial companies, the infrastructure companies that are really seeing robust results. And we just got first quarter earnings. And on average, the industrial companies, they actually saw backlogs growth on average 34%. I have never seen backlogs growing at 34%. But these are companies that put stuff inside the data center. So it's the wiring, it's the tooling, it's the chips, it's the cooling systems, it's the heating system. It's so intricate. And in fact, we had Bruce Richards on a webinar yesterday, and he gave some very interesting stats. Most companies, when they start to build a data center, they're building a 1 gigawatt plant. And so if you're going to build a 1 gigawatt plant, you need 500 acres of land. And so you need the land, you need the box, and that just by itself is $3 billion in cost. Then you have to put all the stuff inside, all the things that I just mentioned. That costs a company anywhere from $35 to $40 billion. This is just for a 1 gigawatt plant. So when you think about it, we have $800 billion that is going to be spent, $1 trillion next year from just the technology companies to fulfill these obligations. And, it takes a long time to build a data center. I mean, it takes a couple years.
Right.
So I think it's really interesting to play it from the industrial companies rather than the semiconductor companies or the memory companies. I mean, I understand why those stocks are going, they're going bonkers. I understand that because we just don't have enough compute. But I think maybe the plays that are a little less understood are some of these others on the industrial side.
So just to play it back to you, Stephanie, constraints may actually be bullish over time.
Sure,
Yeah.
absolutely. But you know what? Constraints are inflationary.
Constraints are inflationary. And here we're coming back. You almost give me a perfect um, new question because we were talking about the market. And now what we see that the market also seems to be broadening.
Yeah.
One of the biggest shifts we have seen is a change in market leadership.
Mhm.
Stephanie, how important is this broadening of the market for the sustainability of this, let me just call it current bull market?
Yeah, I mean, I crave a market that is broad based. I mean, that's the way I was always taught this business, diversification and finding real true values. There are a lot of good values out there that have not participated in this whole, kind of AI boom thing beyond AI. But I mean, look at the companies that are financing this stuff. Most of them are the big banks. The big banks are trading at 1.2 times on average book value, and they have so much excess capital. And I think it would be great to have them participate as well, but they've kind of cooled off a little bit. Discretionary, as I mentioned. I mean, they just doesn't act very well, but the stocks are, some of them are very, very cheap and very compelling. But for now, everyone wants memory, they want semiconductors, they want some Mag 7s, they do want some of this infrastructure, but I still don't think it's really over-owned. And so that has been the leadership for now. I would love to see this just extend out a bit. We'll have to see.
Stephanie, you mentioned the Mag 7. There still is a perception among some investors that parts of the market, especially tech or the Mag 7, remain expensive. You talked
Mhm.
also about valuations. There
Yeah.
could be some sort of a reset through earnings. Do you think an expensive market in Mag 7 is still a narrative that holds?
I think that some of the Mag 7s, I mean, minus Alphabet, but the other Mag 7s, actually, the multiples on average have come down from 40 times, if you add them all together, to about 25 times. And you have some of them that are trading even below 20 times. And I think they're getting penalized from the multiple point of view. And some of the stocks haven't done that well because they're spending enormous amounts of money, and they're going through their free cash flow. And in fact, in some instances, you have negative free cash flow, or in some instances, you have these companies going to the debt market. And I think people feel a little uneasy. But I would say what I would point to, and I would suggest anyone that's listening, take a look and read the CEO of Amazon's shareholder letter. He does it once a year, and it came out a couple of weeks ago. I learned so much from that letter because he explains why they're spending as much, why they're not seeing the return on investment just yet, but that it's going to come, and that if they don't heavily invest, they're going to be behind. That's the summary, but it's incredible what this letter talked about. It also talked a lot about robotics. I think that is a theme that is yet to really be discovered. Some of the names have done a little bit better, but I mean, just speaking of Amazon, they have 1 million robots at the company, and they believe that they are so far seeing savings from these robots, about 2 billion a year, which is not a lot yet. But they think over the next 10 years, they're not going to have to hire 400,000 people because they're going to have robots replace that people, which I think is sort of interesting. And then we only have about 4.7 million robots in the world, and that is going to grow to 577 million robots in the next 25 to 30 years. And that's going to lead to better productivity, which I think is really encouraging. But that's certainly a theme that I believe is yet to be really exploited, and it's something that's very excited. And he talks about this in the letter.
Speaking of the letter, you said it takes time for the return of investment. Let us take this point and bring it back to our clients, the investors. How should we, investors, recalibrate return expectations of the market from here?
Um, well, I think that First and foremost, I mean, I think that over time we are going to see better returns from all of this heavy investment. I just think it's going to take a lot of time and a lot of patience. Because I think what most people want to see is, yeah, we don't mind that these companies are spending this much money, but if is the payback going to be 3 years, 5 years, 10 years? I think it's going to be sooner than what people think. And I think you're getting bargains, especially on the Mag 7 side at this moment in time. In terms of overall market returns, I'm shocked that we're up 8% year to date in the S&P 500. I'm shocked that we're up 16% in the S&P 500 from the March 30th lows. I'm shocked because if you were to have told me in January all of these things, all of these worries and these headwinds, I would have thought we would down double digits, but we're not, and that does again speak to the strong economy, and that does speak to hopefully this war being shorter versus longer. Because if it is shorter, Katie bar the door. We're gonna see double digit returns. Because of the momentum that we're seeing. And again, it goes back to why do we care about the macro? We care about the macro because it impacts the micro, the earnings, the profitability, and that sort of thing.
Stephanie, we're coming to the closing question, and I'm a broken record. I asked you this last month. If we fast forward 12 months, what do you think will be the single most important story driving markets that we are not fully appreciating today?
Well, it's always a good question, and I should remember when you ask me this so that I'm prepared for it. But I think it is going to be, it's still all about the food chain, the AI food chain. It really is. I don't think it's going away. I think the big thing is next year at this time, do we start to see returns on their investments? This time next year, I think we will. Maybe it's not to everyone's liking. Maybe they want more, but I think we will start to see better returns, better results, faster growth, and better profits. What do they do with the CapEx? I believe you're going to continue to see it rise. This year, CapEx is up 75%. Maybe next year it's up 40% to, again, I mentioned $1 trillion. I'll tell you what, the CEO of NVIDIA believes that AI is going to be $7 trillion by 2030. So I go with him. I think you're going to continue to see the spend, but should we see a decrease in the CapEx, that whole food chain is going to get impacted. And I think a lot of people will be really offsides. Don't think that's going to be the case, but that's what I kind of on my mind and the things that I watch.
Stephanie, really interesting. Just a couple of points I want to play back to you, what our clients and friends can look for in the macro environment. The war duration could be the key swing factor. So we want a shorter war. The consumer, stronger than consensus. Will its stable inflation be positive in a good way? The Fed, less about cuts, more about communication. And AI, the constraints are the power and actually a potentially really bullish story for the years. Stephanie, this was incredibly helpful context provided. And exactly why we know with you, we have a disciplined approach to positioning and a long-term perspective. It is always great. Thank you for your insights, Stephanie. And thank you for all of our friends of Hightower Signature Wealth for joining us. We see you next month.
Thanks, Matthias.
Thank you.